Markets just saw the biggest drop in silver prices in a single day in 15 years, but that's only part of the story. I've looked at decades of crises, dollar drops, and industrial demand, and silver could go up again. Here is what my decades of experience show about how to keep your money safe while others panic. Most of my life has been spent trying to figure out how markets work, especially when they are under a lot of stress and change. I've seen gold and silver go up and down dozens of times, but what happened in the markets just yesterday was one of the biggest single-day moves I've seen in decades. Silver, which had been going up and breaking records, fell more than 15% from its recent highs. This was the worst single-day drop for that metal in about 15 years. Gold also had one of its biggest sell-offs in more than a decade. There are two reasons why I have always paid attention to metals like silver. First, silver is both an industrial metal and a store of value. It is used in many areas of modern manufacturing, such as solar panels and electronics. It is also still seen as a safe place to keep money during times of uncertainty. Second, silver's dual nature can make it more volatile than gold, which is good for protecting wealth. It can also create opportunities that can happen when the economy changes quickly. When the market is stressed, currencies can lose value, people's trust can fade, and they may turn to assets that have been stable in the past. But silver doesn't act exactly like gold. It reacts to real economic activity as much as it does to fear. That dual role, practical use and monetary symbolism, is why I have long believed that silver should be taken seriously in any study of financial systems, inflationary cycles, or the weakness of the dollar. This isn't the first time that precious metals have gone through big changes in history. In the 1970s, the world was dealing with high inflation, rising oil prices, geopolitical shocks, and a dollar that was losing value every day. That time set off one of the biggest rises in the price of precious metals in history. People were desperate to protect their savings because inflation was eating away at savings accounts, bonds, and other traditional financial tools. In that environment, gold became the most important symbol of safety. But silver's role was just as important. At times, it outperformed gold in percentage terms because the market was so hungry for real value that couldn't be affected by monetary policy. Silver's rise wasn't just because people were afraid, it was also because there was real demand for it in industry. That combination helped people who were in silver in the 1970s make huge profits. The global financial crisis of 2008 was another important time in the history of precious metals. The stock markets crashed, real estate prices dropped, and people lost faith in banks and other financial institutions overnight. In that moment of panic, people rushed to assets that weren't connected to the solvency of banks or counterparties. Gold, and to a lesser extent silver, rose sharply. I remember that during the last stages of that crisis, when equity valuations looked impossible and central banks were scrambling to come up with new policies, silver had a strong run. This was because markets were desperate for something real that could hold its value across different economic systems. People who bought silver before the crisis were ahead of the game when it came to losing money in other places. The 1970s and 2008 are more than just stories from the past to me. They are lessons that I kept going back to as I watched the markets change. What happened yesterday in the metals markets is similar to what happened before, but in an even more extreme way. Silver prices were at all-time highs because of high global demand and macroeconomic pressure that pushed people into safe haven assets. Then, out of nowhere, prices changed direction, dropping more than 15% in one session. This was the most volatile day in more than 10 years. Gold, which had been doing well on its own, also saw a big drop in price. There are a few big things going on. One is the US dollar. When the dollar gets stronger, silver and gold, which are priced in dollars, usually cost more for people who have other currencies. This lowers demand and lowers prices. Another factor is monetary policy signals. News about possible changes in leadership at the Federal Reserve or changes in expectations for interest rates can change how people think about the market right away. And when markets go parabolic, which means they are overbought, technical traders and algorithmic strategies can quickly place big sell orders when certain levels are broken. When yesterday's move happened, all of these factors came together in a perfect storm, causing big margin liquidations and quick profit taking that made the drop even worse. As someone who has studied how markets work for decades, I always say that volatility is information. This much movement in the market this quickly isn't just random noise. It's the market sending out signals of stress, a need to reassess risk, and a need to realign global capital flows. The fact that silver fell so quickly after hitting record highs tells me that the markets are caught between two strong forces. On one hand, there is real pressure from macroeconomic uncertainty, fears of inflation, and weak currencies that are making people want to buy perceived safe assets. On the other hand, there are people who are making money, people who are taking too many risks, and short-term technical traders who will pull the rug out from under you quickly if things change. That difference is what makes markets go from being orderly to being chaotic, and chaos brings both chance and risk. One of the most important things I've learned, and that I've tried to remember, is that people tend to only pay attention to one side of a story and not the other. A lot of investors look at gold because it is the most well-known safe haven. People often ignore silver because gold is more liquid and has a history of being a safe place to keep money. This has happened to me so many times. Silver is still undervalued because most investors don't think of it as the default metal, even though it often does better than gold in strong rallies. That's a lack of knowledge that can be very important when the market moves a lot. Gold is famous and has been in high demand from institutions for decades. On the other hand, silver serves two purposes: as a monetary hedge and as an industrial commodity. This can lead to misunderstandings in markets that are mostly focused on one story. The big change that happened yesterday shows how quickly people's feelings can change when markets look at risk again. And that leads me to something I've thought about a lot. As financial systems get more connected and monetary policy gets tougher, markets like silver won't act in predictable or linear ways. They will respond to changes in macro sentiment, fiscal policy, geopolitical shocks, and confidence in major currencies like the US dollar. When worries about inflation rise, silver may go up, or it could drop a lot in the short term when people start taking profits and technical triggers take over. Neither extreme is inherently crazy. They are just how people in the market combine their hopes and fears in real time. I can't just look at yesterday's data to see if silver is really about to go up again or if the recent drop is just a short-term correction in a longer-term trend. I need to take a step back and look at the forces that caused that record move and the forces that might cause the next one. That means not only looking at price charts, but also figuring out the macroeconomic forces behind them. This is what I will talk about next. One of the most immediate and surprising things that has happened in the last 24 hours is how people reacted to news about who is in charge of the Federal Reserve. When it was reported that Kevin Warsh, who is widely seen as more orthodox and hawkish on inflation, was being considered for the next Fed chair, the markets reacted strongly. Just that announcement was enough to make the prices of gold and silver drop sharply. Traders moved their positions in response to the possibility of tighter monetary policy and a stronger dollar. Analysts say that part of the recent drop in prices is due to this Warsh effect. People thought that a more hawkish central bank could slow down or put off rate cuts, which had been building expectations of easier monetary conditions. When central banks show that they are going to take a stronger stance on inflation, the dollar usually gets stronger, bond yields can go up, and assets priced in dollars like precious metals can go down. In this case, the markets reacted violently, enough to cause technical selling and margin liquidations, which led to a rise in volatility that was seen in markets all over the world. That sell-off happened so quickly and was so big that it shows how sensitive the metals market has become to expectations about interest rate policy. This is something I've seen many times in my decades of studying market psychology and macro drivers. Expectations can move markets just as much as fundamentals. But calling the reasons for silver's recent moves purely monetary would leave out an important part of the story. Silver's price rises have been driven by strong industrial demand, which is a unique factor that shapes its long-term path. In contrast, gold's price rises have been driven by safe haven bids and central bank reserve demand. Silver has been used more and more in industry over the past 10 years, especially in technology, electronics, renewables, and green energy. Recent data and industry estimates show that a lot of the silver that is used in photovoltaic solar panels, electric cars, 5G infrastructure, and high-tech electronics is now in high demand around the world. Silver's unmatched ability to conduct electricity makes it almost impossible to replace in fields like solar energy. As the world's energy systems move toward renewables, the amount of silver needed to make things structurally rise, regardless of how much people want to invest in it. That's a big difference from gold, which is used in a lot fewer industries and doesn't play a similar role in energy or digital infrastructure. Silver is literally at the crossroads of industrial growth and monetary psychology. This crossroads has helped keep its rally going, even when safe haven flows have gone up and down. Silver is very different from gold when it comes to liquidity and how the market works. This difference creates both chances and risks. The gold market is huge and deep, with very high trading volumes and participation from institutions all over the world. Gold trading volumes are much higher than silver trading volumes. This makes big price changes less likely. The market can handle inflows and outflows without as much price distortion. Silver, on the other hand, has a smaller market size and a shallower liquidity profile. This means that prices can move more quickly in both directions when money comes in or goes out quickly. In recent performance metrics, silver has done much better than gold, with much bigger percentage gains over the same time periods. However, this outperformance has come with a lot of volatility. Gold's price movements have been smoother, even during big rallies. Silver's price movements, on the other hand, have been like a roller coaster, with both upward and downward momentum, which is a risk that comes with a thinner market. Silver's story is different in the current macro environment because it has a higher potential upside and a higher level of volatility. When the dollar is weak, comparing silver and gold also shows an important dynamic. When the dollar goes down, both metals tend to go up in value because they are priced in US dollars around the world. But because silver is used in industry, it often goes up more than gold. On the other hand, when there are short-term technical sales or risk-off flows, silver also tends to do worse on the downside because its smaller market can't handle downside liquidity as well. I have seen this dual behavior in silver over many cycles, higher highs and lower lows. That is why its rallies can feel like they are happening all at once, and its corrections can feel like they are happening all at once. These traits, sensitivity to monetary expectations, growth in industrial demand, and changes in market liquidity, are why silver prices have been so volatile and have reacted so strongly to news in the last few sessions. But these big picture factors also have important warnings. Extreme volatility isn't just a theoretical idea, it's a real risk that can happen when markets take into account a lot of different factors at the same time, like monetary policy, dollar expectations, technological demand, and geopolitical uncertainty. The drop yesterday shows how quickly people's feelings can change when the big picture changes even a little bit. That same sensitivity that caused big upside runs can also cause big short-term pullbacks just as quickly. I've always said that knowing about risk is just as important as knowing about opportunity. This is especially true in markets like silver. Structural factors like a lack of supply and demand in the industrial sector may cause prices to rise over long periods of time, but these same factors can also cause short-term drops to be very severe, especially when interest rate expectations change or safe haven rotations happen. Timing risk is the risk of entering or exiting at the wrong time when things are very unstable. This risk is real and can have a big effect on performance. That's why I've spent so much of my career focusing on strategic positioning instead of taking advantage of opportunities. The market doesn't reward guesses about short-term highs or lows. It rewards careful analysis of big picture factors, controlled exposure, and knowing why a trend exists in the first place. Right now, silver has strong structural industrial demand, changing expectations for monetary policy, and a unique liquidity profile. This suggests that it will continue to be relevant in the long term, but it will be volatile, so you need to be careful how you handle it. When I put all of these factors together, safe haven rotations based on economic news, real industrial adoption from the technology and clean energy sectors, and the pros and cons of gold compared to other assets, I see a complicated but useful picture. Silver isn't a simple hedge like gold. It's a hybrid asset that reacts to both growth and fear. And while that hybrid nature opens up a lot of possibilities, it also comes with real risks that need to be recognized, not ignored. Now that I know both the risks and the potential benefits, the next step in figuring out this current market is to come up with a clear wealth protection strategy with silver that takes into account both the explosive potential and the inherent volatility. Based on my years of experience, I've noticed a pattern. People who bought silver early, especially before the dollar started to weaken or there were systemic crises, often had amazing results. For example, in the 1970s, the US had to deal with high inflation, oil shocks, and a dollar that was losing value quickly. I remember looking at the situation back then and realizing that silver, because of its industrial uses and its history as a store of value, was in a good position to benefit from both fear and real economic demand. People who bought silver before the dollar's real value went down were protected in a way that cash and bonds couldn't. In the same way, when the markets crashed in 2008 and people lost faith in banks, Early buyers of silver and other precious metals were able to keep their wealth and even grow it, while other types of assets were destroyed. It wasn't luck, it was knowing how monetary policy, a weak currency, and real demand all worked together and acting quickly before everyone panicked. These lessons from the past aren't just ideas, they shape how I see the world today. The recent rise and fall in silver prices show the same patterns I saw in those past crises. When markets are sensitive to changes in policy, safe haven rotations, and macroeconomic uncertainty, silver reacts more strongly than gold. However, silver also offers unique chances for preservation and growth. Seeing these patterns is just the first step. The next step is to come up with useful ways to deal with them. Allocation is something I've talked about a lot. Silver should be seen as a part of a larger portfolio that spreads risk across different types of assets. If you don't give it enough, the protection it can offer is very small. Too much allocation means you're too exposed to changes. The key is to be measured and deliberate in your positioning, which shows both your risk tolerance and your understanding of the bigger picture. Another important part is storage and custody. When you hold silver, you have to deal with real-world problems that you don't have to deal with paper assets. In my experience, it's important to make sure that your valuables are safe, whether that means using insured vaults or trusted custodians. Having physical ownership gives you peace of mind that electronic entries can't, especially when there is a lot of uncertainty in the system and trust in financial intermediaries can change. I have also always found that diversifying within precious metals is a good idea. Gold is stable and easy to get, while silver has an asymmetric upside potential because its market and industrial demand are smaller. Putting money into both metals in a smart way instead of just one balances risk and reward. This is because these assets can be used as both a hedge and an industrial commodity. But I've learned that mental preparation is just as important as strategic positioning, even when the right amount is put in the right place and stored safely. Markets are always changing, and silver is more volatile than gold. I've seen investors freak out when prices suddenly change, selling at just the wrong time and losing out on potential gains. I look at these swings in a different way. I look at what caused them, separate short-term noise from long-term trends, and keep a disciplined point of view. One of the most useful things I've ever done is be patient. Even when the daily charts looked crazy, the final result was almost always in line with the big trends I had looked at before. The lesson is clear. Volatility isn't the enemy. Panic and decisions made in the heat of the moment are. Today, ignoring silver is just as risky as its volatility. When I look at the big picture, I see that holding only cash or traditional fixed income instruments leaves you open to losing purchasing power. This is because of high levels of debt, the dollar's constant change, geopolitical uncertainty, and rising industrial demand. History has taught me this lesson many times. When the dollar goes down, the real value of cash goes down too, sometimes by a lot, but precious metals keep their buying power. People who don't understand this dynamic give in to inflation and uncertainty in the system, even when things seem stable. I've seen this happen many times over the years, and it makes me even more sure that metals like silver are important for any long-term preservation plan. Because of these facts, I have looked at silver through a lens of observation, measurement, and planned action. I always keep an eye on macro indicators like U.S. monetary policy, statements from the Federal Reserve, the strength and weakness of the dollar, inflation data, and the global demand for silver in industry. Each of these inputs helps me understand possible changes in the market and the risks involved. I don't try to guess what will happen to prices in the short term because they are often just noise. Instead, I look for signs that have historically come before larger trends, like a long-term drop in the value of the dollar or a quick change in safe haven sentiment. Based on these signs, I have used the strategy of gradually building up rather than trying to time the market perfectly, and it has worked every time. Dynamic reassessment is also part of my approach. Markets change, demand for goods and services changes, and monetary policies change. In the last week, silver has swung wildly, going up to almost record highs before quickly dropping 15%. This has been a useful reminder of how important it is to be flexible with your positioning. It's not enough to set a fixed allocation and forget about it. My investment philosophy has always been based on keeping an eye on things and being willing to change as macro forces change. The combination of careful allocation, safe holding, and strict monitoring is the main part of my plan for getting through these rough markets. In the end, silver is more than just its price chart. It is a combination of lessons from the past, the present state of industry, and big picture economic forces. Having watched cycles for decades, from the inflationary 1970s to the financial crisis of 2008 to now, when policy uncertainty is high and industry is growing, I have learned that silver's potential is not realized through speculation, but through informed, strategic positioning. It is a way to protect against currency depreciation, a way to keep things safe, and a part of a long-term portfolio that is strong. Its performance shows both fear and usefulness, and knowing that duality has guided my own choices and those of my team at Bridgewater over the years. When I think about the current situation, it's clear that silver isn't just a commodity. It's also a strategic hedge and a way to keep your wealth safe. Now is the time to pay attention. In the past, it has shown that it can protect against value loss, take advantage of industrial growth, and give big returns to people who are smart and patient about where they put their money. Throughout my career, I have always followed these rules, carefully studying macroeconomic conditions, making deliberate allocations, keeping things safe, preparing my mind in a disciplined way, and keeping an eye on important indicators. By putting these things together, I have been able to deal with volatility and take advantage of the unique opportunities that silver offers during both crises and times of structural growth. I still believe that strategic positioning in precious metals is a key part of protecting wealth after going through the lessons of history, the macro drivers, and the unique dynamics of silver. Every cycle shows that volatility is both a risk and an opportunity. I've been able to navigate markets for decades by understanding this. If you want to keep up with these insights and learn more about the patterns that shape global markets, subscribing will make sure you always have access to my analysis. If you like this video, it helps show how important it is to have careful, evidence-based points of view in a world that is often full of noise.